Let's talk small bay industrial real estate. Here's how it works, but at the same time, here's how you can lose when investing in this asset class. So small bay industrial, it's been one of the best asset classes in commercial real estate currently in 2026, but also over the last few years. So in this video though, I want to talk about how you can actually lose money in this category. And this is what most videos or pitch decks won't tell you. All right, so in the real estate world, you'll see every broker, every fund manager at the conference keynotes, a lot of the same stories being told. There's low vacancy, there's rising rents, it's fragmented ownership, and this category is recession-resistant. And most of that's true, but it doesn't mean that the risk isn't there. So when you don't understand the downside of any deal, right, you're not investing, you're gambling. And we're not gonna know all the downsides, but here's where I believe the 8 deal killers that show up in this category and what you need to be aware of investing in this asset class. So number one, obviously it's going to be tenant credit. Tenants in these small bay industrials are small businesses. You got the contractors, you got the Shopify brands, you got the local distributors, and small businesses fail a lot. I think it's 90% or more over a 5 or 10 year period. And you're not getting that Amazon institutional covenant behind that rent check, that corporate massive guarantee. You're gonna get 2 guys that give you a personal guarantee, someone who's been in business maybe 3 years or less, and that's a fundamentally different risk profile. And on paper, it looks like you're getting a better return, but the risk isn't factored into that component of the rent roll. A lot of investors aren't seeing that in their underwriting, where the cap rate looks good, the performance looks good, but the creditworthiness of the tenant is going to be shaky many times in these categories. So understanding that risk profile is step one to making sure you make the right small bay investment instead of the wrong one. All right, so here's risk number 2. And this is where I think the fundamental edge in the category is made or lost. It's the management intensity. And I come from the storage background and manufactured housing community investments. It's highly management intensive. This is not passive income, not even close. And small bay fits in that category. You're gonna have 5, 10, up to 50 different tenants in a building, and you'll have 2 separate leases signed, 2 move-outs, move-ins, TI negotiations, maintenance calls, renewal conversations. All of these components add complexity to the property. And that's where, as a passive investor or as an investor that doesn't have an expertise in operations, it's not really fair to say I'm going to hire one leasing broker, I'm going to hire a property management firm, and it's all taken care of. These properties take hands-on oversight. That is where the insiders play. Just like in multifamily or retail or any other category, the investment's only as good as the operator running it. So having the inside peek of how the tenant actually operates, what their business does, what are they looking for, what are their complaints, what are the demographics in the area, what do people want, is there a parking issue? All the complexity around what the end user truly wants to serve their business is that competitive advantage of knowing that as the operator, so you can position the property, market it, and create an experience that they want to be there. And you're going to outperform all the other properties in the area because you know truly what your tenant base wants. And that's why a lot of the industrial investment community is more focused on big warehouse, because there's 1 or 2 tenants, 300,000 square feet, you get 1 check every month, and you don't have to worry about managing the day-to-day operations of that building. So the flip side of that, though, is if that tenant doesn't renew the lease, there's a long period of time to fill that back up. But that can also happen on small bay industrial, where you lose a 5,000 square foot tenant, you lose 3 or 4 of them. You got to go chase the person, collect the money if they didn't pay. And if you don't have that management infrastructure, that's going to hurt you. Knowing the cost involved of managing these assets is critical to understanding how to drive yield, how to actually get investment returns. And it starts right with management. Okay, next risk is tariffs. And we've heard a lot of hype around tariffs in 2025, 2026. And tariffs directly affect e-commerce and import businesses. And this anchors a good 10-20% of the total small bay industrial demand. And I ask myself, why? Is there a lot of e-commerce people in these small industrial units? To a degree, yes, because indirectly, consumer spending, buying things online, affects the demand of these small warehouse spaces, because these warehouse spaces provide an area close by to their customer base where they can pre-pack, they can ship. It's the last mile concept of getting goods to a consumer as fast as possible, especially when you start getting into heavier items, gym equipment, furniture, where you have to put together components of a product and ship it to the customer quickly. You can't afford to have the inventory in a 1 million square foot warehouse or paying Amazon up to 40% for the warehousing cost. So these 5,000 to 10,000 square foot spaces act as these distribution warehouses that e-commerce companies can use that are going to get their product throughout these metro markets that they're serving. So I don't exactly know how tariffs are going to impact all of the tenants that we serve throughout the industrial space. But if retail sales slow down, then light industrial demand will slow down at some way, shape, or form. So brokers tracking this live deal flow in 2025, they saw it happen. The tariffs created, then the pipeline shrank in terms of tenants were getting more cautious. They weren't renewing their leases as quickly, or they were pushing back on renewing at the current market rents. And that was a major shift in demand. And this wasn't abstract. It was happening in the market right away as tariffs were signed. All right, next risk is rent growth. Now, what we're talking about here is in the underwriting and forecasting of a real estate deal, we're looking at what are the future trends. And when you look back at past trends and you see 40% rent growth from 2020 to 2025 in small bay industrial, like that's massive. That dramatically increased the value of this category of assets. But that's not sustainable. I saw it in self-storage as well. And this is where you can get burned, where you're looking at a property and you see that market rents are $18 in a market, and the current owner is charging $15 or $16 annually, and you think, okay, I can unlock this value right away by raising the rents $3. It's not that simple. Right now, the assumption may be that rents are going to have to drop, that those $18 market rents actually aren't stable because there's more supply in the market and there's less tenant demand because small businesses aren't growing as rapidly, or because of some of these issues we're talking about and risks in the category. It's not mark to market right away where you just buy a property, raise it to market rents. There's no cost involved with tenant turnover, with leasing commissions, with the market shifting and the local business environment wanting the space. It's not a given anymore. So how do you buffer that risk? Now, current projections will show maybe 3, 5, 6% rent increases over the next few years. You got to be careful with that. Right now, forecasting flat rent growth, 1% rent growth. It's nominal in the next few years. Investors bought into high rent growth early on in 2019, 2020, me included. We hit the jackpot. But it's better to be lucky than just good. But at the same time, you can't count on luck in the future. So now it's underwriting needs to be airtight. It's not about optimism. It's about a realism. That's going to protect the investment because you don't need all the growth. You're buying at a disciplined basis now, and it's going to cash flow regardless of if the rents go up or not. Okay, so the next risk is what industry insiders would understand. So you must be a fanatic about real estate investing to understand it, but it's the exit cap rate risk. I say that because it's such a complex topic where what are cap rates going to be 5 or 10 years from the time that you buy the property so you can estimate what it's going to be worth at that time. Nobody can tell the future. A smart underwriting test would be stress test is 25 to 50 basis points above where cap rates are today. But that's just a broad general concept. Who knows what the market environment will be? If interest rates are at 6% now, then at least 100 basis points over interest rates would be a very conservative estimate, and that would be a 7% cap rate on the exit. But this is an art as well as a science. Of course, certain markets, core ones like New York, LA, Miami, these are going to be lower cap rates regardless because there's such a strong demand for that real estate. But at the same time, interest rates are going to directly affect the value of these properties. The key piece I want to share here is the market a durable market that's going to continue to grow? If so, cap rates will probably stay lower, quite a bit lower than the national average, due to the demand and desire to want to invest in those markets. But the second thing here is with small bay industrial or even mid bay where you have multi-tenant real estate, like bigger buyers are going to be investing in an operational platform. They're going to want to know that there's strong management systems and teams in place that they can buy into in order to get the yield that they expect from the investment. So I believe fragmented 1 or 2 off buildings in maybe secondary or tertiary markets, the cap rate's not going to be compressed. There's going to be the component of the operations. And a small operator or a small investor can come in. When I say small, I mean, under $10 or $20 million deal. They are going to come in and want a good cap rate because they know the amount of effort it takes to manage these properties. Now, a bigger institutional buyer that's going to buy $20 to $50 million or up to $100 million of a portfolio, they're going to want to look at it like, I don't mind paying a tight cap rate, a lower cap rate, but I want those operations extremely dialed in. And that's where you can maximize value if the management's put into place. I don't want to beat this topic with a dead horse, but I just want to make it clear that the operations fundamentally change the value of real estate, and that's going to affect the cap rate. The more people that see that it's a durable business because there's good operations in place, and the better the markets, the more the demand and the higher price for that property, lower cap rate. If it doesn't check any of those boxes, it's not sizable, it's not in a core market, and there isn't great operations in place, as well as maybe some tenants that really don't have legitimate businesses or the area doesn't serve those businesses, that's going to kill the cap rate. So it's very geographically based, and it's a business that people are buying into. So understanding that up front is what allows great investors to have a realistic expectation of what the true value is going to be worth when someone else is going to want to buy it when it's time to sell. All right, so risk number 6 is flight to quality. And what that means is in 2026, investors are being very picky, real estate investors. They want higher quality assets in higher quality markets, and they're willing to take less of a yield. And the reason being is because value add got extremely overvalued the last 5 years. And now investors are dealing with the hangover of not getting a return because the value add strategy, one, hasn't been fully executed, and two, they bought at too high of a basis. So we're seeing this in large apartment operators as well. I just watched the podcast with Ken McElroy and Grant Cardone, and it highlighted how larger buyers are going to sacrifice yield and they want to own legacy real estate. They want to own the best multifamily assets positioned in the best markets, and they want to hold them forever. And I think investors in this small bay or mid-bay industrial space are going to be very picky because there's a lot of older, obsolete product that got traded at high values that no longer can be traded because investors now see they have more of a choice in what they're going to buy, and they're only going to cherry pick the assets that are going to serve the current needs of the business today. So what does that mean? Well, industrial warehouse tenants and even flex tenants that have some office type use and service business type use is tenants want taller clear heights. So they want higher ceilings so they can use the racking, pull in trucks. If you have low clear heights, nobody wants it. They want better power infrastructure. More equipment, more power needs are needed now with light manufacturing. So that's compared to a lot of other existing small bay inventory, these warehouses that were built in the 70s, the 80s, the 90s, they don't meet that bar. So you can't just raise the clear heights in a property that has 11-foot high ceilings. It doesn't work. So you may be looking at a market to invest in like we are. We're looking at Houston now to buy some of these properties, industrial. It looks supply constrained, but it's only true if the supply is competitive. Like there's functionally obsolete buildings that are older with lower clear heights or they're very outdated metal construction that are going to need a lot of capital expenditures. So there'll be markets that you'll look at that are supply constrained, but if you're buying a building that doesn't actually serve the tenant in this day and age of what they need, you're not comparing the right supply, where there is only going to be a certain amount of demand for the older building that you have, and they're going to go to other properties that meet those requirements. All right, risk number 7, construction costs. So this is a big one where if you're acquiring stabilized assets, this matters less. But if you're repositioning, if you're developing, if you're doing a major CapEx on a project for industrial, construction costs are up significantly. With the tariffs, with inflation, the cost of labor, construction has significantly increased since 2021. So not putting these cost increases into the value add component is going to crush a project because it's not accounting for the true cost it's going to take to reposition a property. And then the final risk, the recession-resistant tagline, which I've used it. I talk about it in the categories that I invest in, that small bay tenants are resilient in a down economy. In a real contraction, they can be, though, some of the most vulnerable. Some of these businesses are undercapitalized. They don't have a good balance sheet where they can buffer an economy dropping. The personal guarantees that some of the tenants give you, they disappear when there's economic volatility in the market. You can't get water out of a stone. So if the economy shifts, there could be an increase to 8, 9, 10% in vacancy. That's a real risk that some of these businesses will turn over. And we could even see rents decline in a year or two, like we did back in 2009 after the Great Financial Recession. So I'm not predicting this, but it's something we need to protect ourselves from in the future in order to weather a storm, because these tenants can turn over fast. And to buffer that risk, it's all about marketing, all about knowing your customer and serving the customer and making sure you're serving their needs, picking up the phone, showing the property, and then getting it released, because you have that leasing system and structure in place to be able to backfill these tenants that are ultimately going to fail in a down economy. All right, so these 8 risks, this is what they tell me, that the small bay thesis is structurally sound. Like, it works, and I'm still developing my company to scale it. But the investors who really win, they're not the passive allocators that are going to do it part-time. They are operators. They are hands-on in the management. A friend of mine lives in Santa Barbara. He owns a handful of these properties in Texas, and it ended up stressing him out, and it affected the returns of the properties, where him as a one-man band with his wife did not have the capacity to manage these assets, and it took a toll on him, not only financially, but emotionally and physically. So that type of investor will not win in this category. The type of investor that'll win are the ones that have real management infrastructure. It's a real business. They have real local market relationships with brokers and other businesses. And then obviously the discipline to underwrite conservatively, both on the entry and the exit. So if the pitch to you is, hey, it's low vacancy and rising rents, that's great, but the story is partially backwards, because the forward-looking story is, what's the operational excellence that is going to deliver value in the market no matter what's going on? So as an investor, great. I think jumping into this asset class is outstanding. If you're a new investor to the class, maybe it's worth partnering or investing in some of these categories before you go head first into these type of assets. I just want to give you the risks up front. And trust me, I've taken the hits. I understand the lessons of 20 years of investing in self-storage, industrial manufactured housing. The edge is learning from these mistakes. I want to share some of these so that you can become a better investor, and at the end of the day, you can make the right decisions that are going to fit your portfolio. So if you want to see how we underwrite these small bay deals, if you want to actually stress test the actual deal and look at cap rates, tenant credit risk, breakdown of markets, comment below deal, or check out one of these next videos, and we'll go deeper into the analysis of how these properties really work. Thanks for watching.